In 1946, American federal debt was 106% of the entire economy. By 1974, it was 23%. Almost none of that was repaid. It was moved, quietly, over 30 years off the government's balance sheet and onto somebody else's. There's a name for how. Economists have used it since 1973, and the IMF published 100 years of evidence on it last month. The term is financial repression. Two Stanford economists, Edward Shaw and Ronald McKinnon, put it into the literature in 1973. Strip it down, and it's one sentence. The government arranges for its own debt to be held at interest rates below the rate of inflation. That's the whole thing. No default, no tax rise, no spending cut. If you lend the government $100 at 3% while prices rise at 5%, you get your $100 back, and it buys less than what you lent. The difference didn't evaporate. It went to the borrower. And the tools are boring on purpose. Interest rate ceilings, reserve requirements, rules that steer banks and pension funds into government bonds, limits on moving money abroad. Nothing dramatic, just a buyer who can't say no.
Here's the case where it definitely happened. In 1940, U.S. public debt was $50.7 billion. By 1945, it was $260 billion, 5 times bigger in 5 years. Then the ratio collapsed, 106% of GDP in 1946, 23% by 1974. Growth did some of that work, but Carmen Reinhart and Belen Sprancia went and measured the rest. Across the advanced economies, real interest rates were negative roughly half the time between 1945 and 1980. For a 12-country sample, they put the interest saved at somewhere between 1 and 5% of GDP per year for 35 years. That is a transfer, and it has a source. It came from everyone holding a government bond or a savings account, and it went to the Treasury. Nobody voted on it, because there was never anything to vote on.
Which brings us to this month. U.S. federal debt just passed $40 trillion. The deficit is tracking toward $2 trillion this fiscal year. Interest on the debt alone now runs about $1 trillion a year. And the long end of the bond market has stopped cooperating. The 30-year Treasury yield went above 5.2% in August, the highest since 2007. On the 19th, Treasury Secretary Scott Bessent announced the government would at least double its buybacks of long-dated bonds. A few weeks before that, the United States and Japan intervened together to support the yen for the first time in 3 decades, and did it without either side selling a single treasury. Japan borrowed dollars against its treasury holdings through an obscure Federal Reserve facility instead. George Saravelos, who runs FX research at Deutsche Bank, described both moves with one phrase: soft-form financial repression, aimed at holding down the long end of the curve.
In July, the IMF published the most systematic measurement anyone has done of this: 17 advanced economies, going back to 1920. The shape is clean. Repression peaks around the Second World War. It falls away through the liberalization of the 80s and 90s, and it starts climbing again after the 2008 financial crisis, and it hasn't stopped climbing. Their conclusion is careful, and the caution is the point. The historical conditions associated with repression are present today, so its use may increase going forward. This is a working paper about a risk. It is not an announcement, and it is not a forecast.
Now, the part that every video above this one in the search results leaves out: run the test. Financial repression means real returns below zero. So in August 2026, a 3-month Treasury bill pays about 3.8%. Inflation is 3.4%. You're ahead by 0.4 of a percentage point. Thin, but positive. At the long end, it isn't even close. The 30-year is at a 19-year high. A successfully repressed long end does not do that. The Treasury announced the buybacks, and the market gave the whole move back inside a day. And the IMF's own paper makes the argument against itself. The post-war playbook worked because banks were captive, capital couldn't leave the country, and savers had nowhere else to put money. None of those 3 things is true now. This is a risk with a century of precedent behind it. It is not a diagnosis.
What it is Paying down a government's debt using the gap between interest and inflation. How it paid off a war? 35 years of slightly negative real returns that nobody had to vote for. Whether it's happening now? Not yet, by the only test that matters. So here's what to actually watch. Not the debt number. That headline runs every year and tells you nothing. Watch whether real yields go below zero and stay there. That's the entire mechanism, and it's a number you can check yourself in about a minute. The reason this works, historically, is that it's boring. Nobody marches over a rate that's half a point too low.